opportunities in emerging markets. My name is Carmen Kester, and I'm happy to guide you through our today's webinar. I believe we have prepared a very interesting program. So let's stick to the next slide. We will shortly speak about the markets, and then we will deep dive into two very attractive funds in our sustainable offer, the Raiffeisen Sustainable Emerging Market Local Bond and the Raiffeisen Sustainable Emerging Market Equity Fund. And I'm very happy that I'm joined by two very well-known experts in this field with a very long-standing history. On one hand, there is Ronald Schneider, CFA, Head of Emerging Market Bonds. And on the other side, we have Jürgen Meyer, also a chartered financial analyst holder, who is Senior Fund Manager in Emerging Market Equities. Ronald Schneider can actually look back on more than 2 decades in history in emerging market bonds. And also Jürgen, he joined actually the Raiffeisen Capital Management Fund team in 2006. He can look back on a very good track record, I would say, in his field. These two will also answer questions. If you have one, you can ask them actually in the chat and we will try to pick them up. Of course, if we don't have the time, so you know, one hour is very short, we will come back to you after the webinar. Let us start with a short look on the history where we started. We have Raiffeisen Capital Management, a very long-standing history. We started in 1994 with our first fund launch in Eastern Europe, and then we expanded our range gradually into emerging markets globally. Our Raiffeisen Emerging Market Equity dates back in 1999, but actually he was merged away into our sustainable emerging market equity funds later on. And I think we can be very proud that we have a more than 5 years history in managing a sustainable emerging market equity product as we launched this fund in 2017. You know, at Raiffeisen Capital Management, we have been reworking our product range intensively in order to always comply with our very rigid approach that we have in this field. So it took us a little bit more time on the bond side to elaborate a product actually, which is really state of the art also in the bond side. And in 2021, we were able to change our existing emerging market local bond to a really Article 8 fund. And this one, Ron Schneider will talk about later. Which is very, I think, special to our management is that we always have a team approach. On the equity side, you have Jürgen Meyer, who is the lead fund manager of the global equity product. But beside, he has specialists for Eastern Europe, for LATAM, and also for Asia. Jürgen himself has been an expert in Asia since the very beginning of his career. On the bond side as well, we have a regionalized specialization, and we always have then a lead fund manager for each of our products. And I think this is very valuable, as at the end, you always have the control for the portfolio by someone, but you have the best ideas which are gathered together and put together in an interesting product offer. Yeah, and with that, I think I talked a lot because, as I said, we have our experts with us who can tell you a lot more about the markets and also our products. And I would like to hand over to Ron, who prepared some slides actually on the markets. And he starts with the emerging market local markets, which did not meet the expectations this year, Ron. Is this correct?
Yeah, that's probably correct. We had quite a difficult year, but not emerging markets local, not only emerging local markets, but I think general all markets had a very difficult year. There have been several facts and instances happening, but also that most importantly, probably the changeover of the US Fed and the unprecedented, I think, speed of rates increase from the US Central Bank did steer up the markets quite significantly. And but today I want to talk about local markets, and I start with the presentation also to bring a little bit of feeling about what do we mean with the markets, and that this market, the emerging markets, local bonds are actually a quite heterogeneous universe. And on the left-hand chart, you can see the bond market and as well as the local bond and the currency performance and the aggregate performance of the respective markets in euro. And you can clearly see that there has been different aspects in place there. Certainly, Central and Eastern Europe markets have been heavily affected by the Russian aggression against Ukraine and the subsequent increase in energy prices and the effects on the outlook for not only for the economic cycle in Europe, but also for the current account balances in the region. So that we have quite a negative effect there. Whereas on the other side, in Asia, we had quite a different development. Not only the inflationary impact has been different, but also the currency markets to react quite differently. And on the other side of the Atlantic, we see then Latin America has quite a diverse development, but still not and not too bad, but quite a big differentiation between the various markets there. So the point is, emerging markets are not a heterogeneous asset class, but rather a set of countries which are quite different, and the approach needs to differentiate against between these countries. On the right-hand side, on the other hand, I had a display an aggregate performance of the um, EM local markets. And the split up is here. You see in green the local bond performance in local currency, the currency development in dollar, in gray, where you see that we have seen quite a significant depreciation against the dollar. Whereas for us, luckily, the currencies against the euro did not depreciate that much, as we have simultaneously a strong appreciation of the euro against the dollar against the euro. And this helped obviously in terms of a little bit in terms of performance, but overall, I think opposed to the market expectations at the beginning of this year, where we did not anticipate such events and strong rate increases, the performance has been slightly disappointing. Going forward and talking about the outlook, there is certainly a question if this is now the euro development or the dollar development is a headwind, or this could change. And this could be the case, but the important topic is that against the reference currency, against the dollar, these currencies are relatively cheap. And the question is whether we see a reversal of the strong dollar against the euro, which could be then a headwind for a euro-based investor. But we think that we would not expect that to happen. We see the euro a little bit stronger towards next year, but not significantly. Maybe Carmen, could you go back to the slide before? Because I still was on the first slide here. So going forward, what has happened in these markets? So the EM central bank actually have been early and ahead of the US Fed in raising interest rates, reacting to the different inflationary dynamics that we have seen in emerging market countries. Namely, Brazil was one of the first to hike rates. And therefore they are well ahead, and they are already starting to end this rate hike cycle. Again, Brazil did stop and indicated that they have reached the peak with this 13.75 rates of the key rate in Brazil, of the Selic rate, and other are likely to follow. And this brings us as an investor. This brings less pressure on the yield developments, which you can see on the right-hand slide or the right-hand chart of this slide. Where you see that we have witnessed, especially in the last year, but also a significant rise in yields on the local bonds. And this gives us now a better entry point, so to say. So the outlook is certainly improved. You also see here there is a significant differentiation between the region. Latin America has very high yields now, and also South Africa, but also Central and Eastern Europe has now in aggregate yields we have not seen for quite a while, whereas in Asia the yield level is still relatively low. This is certainly a lot of due to the fact that China has quite a significant different inflation dynamic. So going forward, we see not only an improved situation from the yield levels, but also the potential that the headwind from rising rates are coming to an end in the CE bond markets. However, and the question is obviously, will the Fed continue to hike rates? Priced in is at the moment some 5 percentage points. And could be the risk that they hike more. But I think the most part of the rise we have already seen. In general, however, one has to say that 5% interest rate in the dollar riskless asset and maybe 3% in the euro riskless asset could be quite a different global environment, or is definitely a different global environment for global markets in general, and therefore we will not see a reversal or a return to that low levels of yields and rates that we have seen before. Good news maybe for an investor for the outlook. So maybe going forward to the next slide, we will also talk later on the headwind that the strong dollar poses for not only for bond markets but also for the equity markets. And here you see a chart of EMFX against the broader US dollar. This is a sign for rising or a symptom, I would say, of capital outflows from the markets due to rising US rates. So the riskless asset becomes more attractive, but also a sign of general risk aversion and possibly risk perception of a risk of a global downturn in economic growth. In our opinion, as I already said, most of the interest rate rises of the US Fed is already priced in. We do not expect significant further rate hikes there, opposed to what is already priced in. And secondly, we are a little bit more positive on the global outlook, especially in China, where there's a lot of concern about global growth going forward. So if we go to the next slide, what we have seen here in global markets and especially in emerging markets is that there is a renewed focus on refinancing. And countries with high current account deficits, with high public deficits or high public debt, and in general high refinancing need, became more and more under scrutiny. And more countries had to turn to the IMF in the last 1.5 years. Having said that, this is not the focus of these products, the frontier markets, which are at high risk of debt sustainability, but rather we focused on more developed emerging markets currencies, so to say. And in aggregate, we see that that we have a current account surplus in emerging markets in aggregate, as most of these countries are commodity exporters and benefiting from that development. And debt levels are significantly lower compared to the developed world. Having said that, they have been increasing recently, and there is a differentiation not only between the regions that we see here, but especially between countries. And the need for a differentiation between countries and a selective approach in which currency and which markets you are investing is of high importance in our universe. And maybe going forward to the next slide, this withdrawal of liquidity has also brought market stress and increased market volatility, not only in the developed markets, but also in the rate markets of emerging markets. We have also seen stress levels in frontier markets with respect to debt sustainability. So in hard currency issues, there is increasingly more and more debt restructuring are priced in. As I said again, I already said again here, this is not an issue for those markets where we are focusing here. But this is a phenomenon which is likely to happen in this withdrawal of liquidity situation. And this spike of volatility and this market stress um, could even be a late cycle phenomenon and could also indicate that this development has run already relatively further ahead. So maybe a little bit early to call it an end of the risks from that trends that we are seeing. But what is certainly the case that positioning in these markets is definitely much lighter after several years already, I have to say, of capital outflows from our markets. So maybe I hand over to you, Carmen, again.
Well, thank
Um,
you. I think that's a lot of very valuable information because we have known that we've seen a lot of outflows. So many investors have shed away from this asset class. And of course, emerging markets can't escape the global challenges that we face, but still they are kind of resilient, we can say. And it would be, if I understood it right, a good opportunity point to enter because we are already, or we might be already be a late cycle. As you said, a lot has been priced in and a lot has been anticipated by the markets. Is this correct? Could be summed it up like that?
I would see it as a very good assessment. Well, this goes a little bit already into the outlook. I've only recently participated in a discussion and also in a survey. And um, some investors actually posed the question, what would be a trigger to turn more positive on emerging markets? And three factors have been mentioned. First, a quick end of the war. We are very skeptical on that to happen. War in Ukraine. Second, an end of the rate hikes by the US. This is, I think, more likely to come sooner or later. Already, we have already priced in, as I've already mentioned, a lot of that. And the third issue was um, a large stimulus program from China to counterbalance the COVID effects. We have already seen large stimulus programs, and we are more positive that these measures that they are taking there will lead to an improved economic outlook there. Yeah, so summing up, I think we are a little bit more positive, or we are more positive on the outlook for next year.
Great stuff. Thank you very much. We will talk about China a bit later on as well, because this is, of course, a topic that is burning among our investors, and also the zero COVID policy in the past did certainly not help, but there seemed to be some relief there as well. So this could add also positively. But let's focus now on the fund that your team is managing. And as you have managed the performance over the last years in emerging market, the local bonds has generally been stagnating, let's call it like that. As we can see here over the last 10 years, investors would not have earned a lot. Maybe you can comment on that and then also proceed to explaining the investment process that you're currently implementing.
Yeah, certainly. Yeah, the last years have been disappointing, and we have seen significant weakness of currencies, especially the currencies have been detracting from the performance. Basically, since 2013, we see more skepticism and more headwinds to EM currencies. We spoke already about the dollar. Maybe this will be a topic later again. But also the topic of deglobalization and introduction of trade barriers. President Trump is the poster child, so to say, for that development. But this has dragged on and was a headwind. And there was an attempt in 2019 when we saw an improved economic outlook, but this came quickly to an end with the COVID, and since then we have not recovered. This has also brought lower interest rates, and the rate rises and the yield rises had been detrimental for the fund performance recently, as well, as I said already. So we have now depreciated currencies against the dollar. We have higher yield levels on that. So this I already don't want to repeat myself, but I already mentioned that the outlook is somewhat improved for that. So going forward, if we talk about our approach and our principles that we are enacting, I think important is to mention that we have moved first from an relative management relative to an index, relative benchmark approach to an more active approach, which introduced absolute return features, while on the same method uh, maintaining asset class characteristics, so setting up rules to be fully invested and not have absolute return features which goes in and out very cautiously. And only last year, you already mentioned, we introduced ESG into our investment process, which is now an important, which brought important changes to the, especially in the security selection. Important to mention here is maybe that we want to have a combination of a top-down approach where we have an opinion about the attractivity and the development of the asset class in general, where we control for the FX exposure and the duration, but also the market beta. And on the second part, a selection of countries which should fit in the dominant market topic. This is a key feature, and this allows to take quite significant position in the core markets that ranges from 0 weighting to 16% weighting. For example, this has been also helpful at the beginning of this year, where we avoided to be invested in Russia at all, which was quite helpful in terms of performance avoidance of this significant downturn here. So for us, it is important to identify the relevant market topic and decide on which countries is on absolute return expectations attractive. We do that on a team approach. And in the same time, in the same way, we also integrated ESG into our investment process. So assessing which countries is affected by the various topics which come from ESG, and also which risks could come from ESG, but also which benefits could come from ESG. This is then added with rules for portfolio construction, maintaining asset class characteristics close to a reference index. And the aim of this fund is to avoid drawdowns, be invested for opportunities, and the target we defined here is a Sharpe ratio target relative to our benchmark.
Thank you, Ron. Can I just interfere here a little bit?
Please,
Because
yeah.
I mean, the fund has been launched in 2010. When did you then change it towards a more Sharpe ratio oriented approach?
This we did in mid 2015. So we have some 6.5 years, 7 years experience with that approach. And since last year, we moved over to, we introduced the ESG.
And did this Sharpe ratio oriented approach already actually help you, I would say, eliminating some of the countries that you wouldn't be also exposed to now, applying this more ESG oriented approach? Is this something where we can say there was a first step already in the right direction?
Well, I would say the avoidance of countries due to ESG. We have actually, what I did not mention, we also updated our approach for countries to be avoided in emerging markets, coming from default risks, debt sustainability stuff, but also from ESG risks. In this fund, we have not been invested in countries where we have excluded these countries. The approach in general helped us, as I already mentioned, for example, to avoid Russia and reduced the positioning of Russia before the actual invasion in Ukraine. So in this respect, this approach helped us to reduce the exposure at all, opposed to a relative approach where we would have moved maybe only to an underweight positioning. In terms of ESG, an elimination of a market in that sense has not been happening. But when we go to the next slide, what was necessary because of our negative criterias, the sovereign bonds, the government bonds of most of the countries where we are active in are not allowed to be invested as they have well, we have a set of negative criterias. They're ranging from atomic energy usage, about military budget and child labor stuff like this, human rights. And this is a very high level of ambition that we have, and we are not, and most of the countries are actually not investable. Not the countries, but the sovereigns are not investable. So we had to use an approach to make use of a different in terms of instrument selection. So we have here the opportunity to have an alternative investment vehicle, which is supranational instruments, so bonds issued by supranational issuers, which are active in that countries, in that region, and are financing and helping the development of project finance in emerging markets. This has positive effects for well, obviously they have a high ESG score, but also they have a high credit quality. So this is beneficial for the fund in a sense that we use instruments and invest in instruments which have a high ESG level, as I already mentioned. So if you want to, you can argue that this is a very good way to invest in supporting emerging markets in their development in terms of improvement in all kinds of ways. But the development banks, where we are investing in, they're also focusing on improvement in terms of ESGs. In general, we have to say that ESG is obviously difficult in emerging markets, as the level of ESG, we also use our ESG score here. When you look at the ESG score of emerging markets, they are significantly lowered compared to developed markets. And this has to do that they have less social standards. The governance is usually lower, and it has also to do with the situation where emerging markets are in general, that they are exporters of raw materials. They have the deposits there. The extraction is dirty, so to say. And well, there has been a relocation of production facilities to emerging markets due to lower income levels, but also due to lower standards there. So this makes it ESG on a sovereign scale a difficult topic. But if you want to change thing in terms of ESG, this offers opportunity also to improve things. So if you want to move something in terms of ESG, EM is probably a good region to be invested in. So I've already talked a little bit. Yeah, please.
Absolutely agreed, Ron. I mean, we have pictured here the sovereign indicator. I would like to jump over it because I think it's very, very time consuming to explain it in detail, all the details that you have been considering and that you're calculating in there. But you have brought, I think, a very interesting slide as well, something that is brought up very often by our clients. How is actually the data quality in emerging markets? And maybe you could comment on that compared to the developed market.
Yeah, sure. This is certainly an issue, and we had. I was involved in the construction of our sovereign indicator, and we had to ensure that there is a comparability between developed markets and emerging markets, and it was not so easy to find really good data to ensure this comparability. What I brought here with me is that not only was ESG a headwind for emerging markets because of the lower standards, but also because of the lack of data availability and the scarcity of liquidity brought the attention of the issuers so the governments in emerging markets. And what we see here that there's a significant improvement in the data providence and then the data quality. There are more and more countries have investor relations who ask which data are needed. They are offering more websites, but as you see on the right-hand side, there is lots rooms to improve here as well. But is in the focus of the attention of in the region, and this is certainly necessary for those countries to improve further to attract the monies which are needed to improve and to achieve also their debt sustainability, not the debt sustainability, but the sustainability targets in general, I would say. Yeah, maybe for
Yeah,
time constraints, I think we speed up a little bit.
Yeah, absolutely. So, I mean, data availability is certainly there for these supranational issuers if we want to judge them. And for the one who are listening, in the appendix, you will actually find an example how we will also assess a supranational issuer from the issuance side. So, not only from the country risk side, but maybe you could sum up the general considerations, what the impact to the portfolios are as we're investing more in supranational issuers.
Yeah, I think the most important features I've already mentioned, they have offered a higher ESG rating, they have a better rating quality. On the other hand, the liquidity is somewhat reduced. And again, on the other side, we have opportunities because the cost of setting up local custodians and stuff like this, so the access is easier. So there are cost benefits. You have liquidity. Constraints to some extent, although this asset class has improved in terms of volume and in terms of issuers and also countries or currencies where this issuer are issuing. And there is also a tendency to that this market is larger in the shorter maturities. So this is a little bit a factor which was not a negative feature for the period when the yields have been rising, but now it will be more attractive, and we see more and more demand for longer dated bonds. So this also will improve, and the market will develop further. So I think this is the most important feature here. And so maybe sum up where we are currently positioned. We have from the top-down side, as I said, we have already turned more positive. We increased our duration positioning. We also increased our currency exposure as we see interest rate rises have coming to an end. We have now reduced our regional exposure to Asia and increased our exposure to commodity producers, especially LATAM, but also South Africa, as you can see here. Mexico is also for us attractive as the linkage to the US economy is still strong. And what we're also looking is at the high real yield currencies, which is mainly Brazil, Indonesia, but also but also Mexico, for example, and South Africa, I mentioned already. And the characteristics of the fund you see here, we have quite a high share of supranational investments issuers where we're invested in, and therefore a very good rating quality. What is not here, with that we achieve an ESG score above 60 or above 80, which is quite good, I would say. So that would be my presentation, actually.
Thank you very much, Ron. We have summed up here the attractiveness of the markets in terms of yield spreads, currency valuations. I think that's definitely very well outlined by you, Ron. Investment process, I think, is very clear and transparent as well. We have also obtained the Austrian Eco label for this fund, and we also can show the contributions it makes to special SDG, Sustainable Development Goals, which you can see here. With this, finally, now it's time to come to the equity side. And I would like to hand over to Jürgen Meyer, who also started with a kind of a macro chart, the difficulties for AM equities to perform in a strong US dollar environment. Jürgen, can you comment on this, please?
Yes, thanks, Carmen. As Ron already mentioned, a strong US dollar is not only bad for emerging markets bonds, but also for emerging markets equities. And what I would like to show you with this chart is if you look at the golden chart, it shows you like the relative performance of emerging markets equities versus developed markets. And the blue chart shows you the development of the US dollar. If it goes up, it shows like a stronger US dollar. If it goes down, it is like a weaker US dollar. And what you can see here clearly is that always when there's like a strong US dollar, this is quite bad for emerging markets equities. And we have seen this now since 2011 that together with a very strong US dollar environment, emerging markets underperformed significantly developed markets. So since 2010, 2011, we now have this underperformance from emerging markets equities versus developed markets equities. If we want to see it in a positive way, the good thing is that if we look back until the 1980s, it normally shows that over like it always ribbons in like a 10-year cycle. So it goes 10 years, emerging markets outperform, 10 years they underperform, outperform again, also underperform. So we are almost at the end of another 10 years of relative underperformance. And so hopefully should see then better next 5 to 10 years. And what we can also say is that on the valuation side, emerging markets look already very attractive, yeah, because if you look on a PE basis, emerging markets are currently trading at around 10 times earnings compared to the MSCI World, which is around at 16 times earnings. Also on a price to book basis, we are trading at a 45% discount to developed markets equities. So there is value in emerging markets, and we hope that the next 5 to 10 years are significantly better than the last 5 to 10 years.
We definitely hope this. But I think you navigated very well also in these challenging, difficult waters. We will talk about the performance later, but maybe, Jürgen, you can now explain how you actually pick the stocks in the Raiffeisen Sustainable Emerging Market Equity Fund.
Yes, of course. So we have been one of the first investors which also applied a very strict rules on sustainability investments in emerging markets. We started the fund in 2017, and I still remember as a meeting some Indian companies, meeting the management there, and when we asked some questions regarding ESG, I just saw the question marks in the eyes. So it was quite a difficult topic back in 2017. But the big advantage we have is that this goal that we get more and more information on ESG data and also on sustainability data, it improved a lot over the last years. Yeah, when we started the fund in 2017, also the number of stocks investable for us was significantly smaller, and this has increased significantly over the last years. So therefore, we see really like a really strong development that also emerging markets equities are now open for sustainable investments, and it's also making our life easier that we also can choose from significantly more companies which could fit into our portfolio. Coming to the investment process itself, so how does it work? So we are currently get sustainability data for around 1,000 equities in our emerging markets universe, and then we implement some negative criteria. That means also all stocks are not allowed which have some violation for human rights, violation on some labor rights. We also don't invest in any coal producing stocks. We don't invest in stocks which are in the production and trade in military goods. We also don't invest in stocks in exploration companies, oil, gas, and so on. So this means that around 20% of the total universe are getting excluded after this first step. And then the second step, it's like a detailed sustainability and financial analysis. That means we use our own Raiffeisen ESG indicator. There's like a certain indicator for every stock, and we have also like a threshold. Under a certain threshold, we are not allowed to invest in these companies. We also have an Raiffeisen ESG country indicator. That means countries which don't qualify on this level, there we are not allowed to invest in companies where the state owns a majority in these companies. So, for example, like companies in Saudi Arabia, Turkey, Pakistan would be not allowed for us to invest. And after the second step, around 50% fall out of the total universe. So there might be like 500 stocks over after first and second step here. And with the stocks where we see the highest potential, we built in a portfolio of around 70 to 90 stocks. So currently we have a little bit more than 80 stocks in our portfolio. And what is also very important for us in emerging markets is this engagement. Yeah, so it's very important for us to convince management that they should provide us with the necessary data. We also try to push them softly in a direction that, as if we know that the companies are sustainable and also the business processes are sustainable, that they also should go this way, that they present all the necessary data to the rating agencies and also send us the necessary informations. And what is also then very important is this voting. That means that at annual shareholder meetings, we also vote if we are something against it. We also say no to something which are against our sustainability criteria. So this would be like the investment process, which I think it's very important, especially on the engagement side in the emerging markets equity world.
Thank you. That was a very clear explanation. Maybe one comment also on the data. We work with MSCI and ISS ESG, something that we might also tell here, of course, that we work with external data provider. But coming to the next topic, which is probably the most interesting for our audience, is you brought an example of a stock that you have significantly weighted also in the portfolio. Can you maybe explain why it is so prominent in the portfolio?
Yes, Taiwan Semiconductor Manufacturing. It's currently the biggest stock in our fund, and it was also most of the time since 2017 the biggest fund, the biggest stock in our fund. Taiwan Semiconductor, it's the world's biggest foundry. That they are like an independent producer of computer microchips, and they produce for all the big guys. They are like Apple, Nvidia, Broadcom, etc. And what is very interesting is because on the one side, they have a really good outlook because they're like in a structural growth environment. Yeah, that means if somebody buys a new car, it has more microchips than like the car bought like 5 years ago. If you currently buy like a new computer equipment, or if you buy something for your kitchen, so it also has some microchips inside. So it's like a environment where structurally we need more and more computer microchips in all these equipments. And therefore, Taiwan Semiconductor has currently a global market share of 55%. For this very sophisticated microchips, they even have a market share of 90%. So their competitors would be like a Samsung Electronics and Intel in US, but that's it. And it's currently impossible for some Chinese competitors to even get close to the know-how and knowledge which Taiwan Semiconductor has here in producing these microchips. So therefore, also on the one side, this very positive structural outlook, and on the other side, also in terms of ESG, it's one of the poster boys in our portfolio. That means we like the company because they are the world leader in terms of conserving water and also this wastewater management. So just to give you some numbers, currently there are the water needed for the production of one microchip is reduced by 8% per annum over the last years. So this is very positive and significantly better than competitors. Then also how they treat their employees, how they educate the employees. They are like the poster boy within the semiconductor industry here in our environment. They also use new terms of energy, also like solar power, wind power, and so on. So they are going in the right direction, and it's also the stock in our portfolio which has the highest internal Raiffeisen ESG indicator score.
Well, thank you very much, Jürgen. You also brought the top 10, and I guess you could probably comment on each and every stock of that in very detail, as you know them by heart. But it strikes on this slide actually that we have some positions that are very strongly weighted, and others are, let's say, under 2%. What is the reason behind these weightings?
Yeah, so normally we start with a building position of a new stock between like 0.5 to 4%, depending on the potential upside the stock has, and also due to liquidity reasons. So, for example, like a Taiwan Semiconductor, they started at around 4% in 2017, and just because they have done so well, they also increased in the stakes. So, similar also for the other stocks. So, therefore, it's mainly a reason of potential upside and also the liquidity in the name. But what you can also see is that so we do not only have like technology holders, we also have a lot of financial stocks in our universe. So for example, some Indian ones like a housing development finance, which are leading in the themes of like financial inclusion, and also they are financing affordable housing. So we also like this kind of financial stocks which are doing a good job here and also bringing people into the workforce, getting them some loan that they can be there like a one person employer and so on. So therefore, we like also this kind of companies, which maybe differentiates us a little bit from our competitors.
Very valid information. In the next slide, I mean, you have brought us actually the country and sector split, and we can see here this financial overweight, probably we can call it, towards other portfolios in emerging markets. Is that what you're
This
saying?
Yeah, this is right. Yeah, so we like a lot of different financial companies. We also have some holdings in South Korea on the banking side, also in South America. Therefore, overall, we think it's a good way of also very good environmental score, also very good social score for certain banks. And also in terms of valuation, we see some significantly upside in all these names. And if you look at the country structure of our fund, you see that China now also has become number one. We would maybe have we increased the positions here in the last years. Maybe we should have waited a little bit because the stock market has been quite weak. But at the same time, we see really good upside also in all the names which you currently hold in the portfolio. So therefore, if you go back to 2007, when we started the fund, also China was not the number one portfolio here. It was by far Taiwan. But also if you compare us to like a normal MSCI emerging markets index or an emerging markets ETF, you would see that we are structural overweight in countries like Taiwan, India, and also Indonesia. And at the same time underweight in other countries. And also on the sector basis, we'll be like overweight in like a financial sector, information technology sector, telecommunication service sector, and we currently have zero exposure to energy names, very small exposure to materials and so on, because of this environmental impact of the stocks.
Okay, this is quite interesting that we are so highly weighted in China, because there's a lot of skepticism also out there towards
That's right.
sustainability in China. But I think you have also addressed this in the next slides, and maybe you could comment if you also invest in state-owned companies. I would think no, because you mentioned before you're not allowed to invest in Pakistan, for instance, or Saudi Arabia. So I would say Chinese companies that are state-owned are not that sustainable neither.
Yeah, China, it's a very difficult topic, I have to say. And I just want to give you maybe some input, because we also get a lot of questions, and there was also a lot of negative news report out over the last quarters and even years. In my opinion, what changed this structure for the Chinese government over the last years is that what didn't work out for them was that they still see the number of babies coming down significantly over the last years. Also, like a few years back, we have been running at like 15, 16, 70 million babies, newborn babies per year. This has come down to 10.6 million last year and will be below 10 million this year. And what it means is that despite the Chinese government be open, that also they now allowed having like 2 children since 2016. They also allowed to have like 3 children since last year. But despite all these measurements, still the numbers of babies are coming down. And this means this forced the Chinese government that they have to do something. And therefore, they came up with this common prosperity. And also, they want to make it easier for people with child to own like a flat, also to pay for the education. And therefore, we have seen all these measurements, yeah, that currently the government is putting pressure on the property prices so that it's easier that you can also live like in a bigger flat. They also have brought down prices for education. So therefore, it should be easier also to give you like a good education for your child and so on. And all these measurements have taken that there's some structural reforms happening in China, which also hurt the performance of certain sectors in China. But at the same time, I think it's also some good opportunity in other sectors that we shouldn't forget. If we switch to the next slide, that also a lot of positive things are happening in China. For example, to reach these global climate goals, it's impossible to don't have China in the boat, yeah, because we can be as strict and as prudent in Austria, Germany, and so on in Europe, that without the help of China, India, and the other big emerging markets, we will not achieve these climate goals worldwide. And therefore, we also currently really like this sector, which are investing in this renewable energy within China, because what you can see here is just a comparison of percentage of the energy needs, which is currently coming out of certain sectors. And here you see that on the solar side and on the wind side, there's a huge potential building here up for the Chinese market. And also don't forget, currently China already is responsible for 50% of all global investments in renewable energy. So as it's more than US, Europe, and all the other emerging markets together. So also already a lot of investments are happening here. And I was just wanted to mention a few names. For example, like we own this Jinji Solar in our portfolio. They have like a 35% global market share for solar glass, and they're benefiting that these new solar modules now have like the solar glass on both sides. So this is a really, really strong trend. They're also exporting to Europe and US, so that's quite good. Longi Green, they are one of the world's biggest producer of solar wafers. So also very good outlook. They have like a 40% market share in China. Goldwind is one of the biggest wind producers in China. BYD, it's currently the biggest electric car producer worldwide and also the biggest electric car producer in China. And they also produce batteries. So also here we see some big opportunities, not only for the coming months. So that will be a really big theme going on for the next 5 to 10 years.
Thank you, Jürgen. So I think we should not always look backwards, but as you say, we have to look to the future. Still taking a little bit a look to the performance backwards. I think you and your team, you can be extremely proud of what you have achieved over the last 5 years. Maybe you would like to comment a little bit what has been maybe the highlights.
Yes, we are really lucky to show also this good performance, and I'm really proud of my team that we achieved done a really good job over the last 5 years. As you can see here, that overall emerging markets, if you look at the emerging markets benchmark, it would be like slightly negative for the last 5 years. Despite that, we achieved a performance of around 14.2%. So that means like a outperformance of around 2.7% on a gross basis compared to an MSCI Emerging Markets benchmark or MSCI Emerging Markets ETF. So therefore, we are quite lucky. We always said that ESG investments in emerging markets, it should be no disadvantage for our investors. So we're also quite happy that it even delivered a very positive performance. And you can also see that in the peer group, we are like in the first quartile over 1 year, 3 year, and 5 years. So therefore, we are quite happy with the performance, and hopefully should also see a very good performance here for the coming years.
Excellent, Jürgen. Thank you very much also for keeping the time. I think we have jumped somewhere now where we should not be. So I would like to just sum up to come to the end. We are 5 minutes before the end, and I would like to sum up to what my two colleagues mentioned. I think we've heard a lot that you can only achieve climate goals with emerging markets. They are important. This is where we currently outsource, I would say, our CO2 footprint too. We have two very interesting products on one side, on the local bond side, where you can invest mainly with supranational in very interesting countries and profit from rising yields. And on the other hand, we have a very interesting emerging market equity portfolio, which has been managing according to the same approach since 2017. So we look back on 5 years of track record. And also this fund is a Article 8 fund. It carries the F&G label, so the Forum Nachhaltiger Geldanlagen label, actually 3 stars, so that's the best possible achievement. It also carries the Austrian Eco label, and also therefore we can offer an ESG reporting with a special contribution to the mentioned sustainable development goals. If you have further questions to these funds, please don't hesitate to contact your client relationship manager. You will find the video summary as usual on the link that also my colleague Birgit Ferschel posted in the chat. She also posted the 2 fund profile. You will see at the end also the key facts where you can see the different share classes and corresponding fees. If you would like to subscribe to any of the fees, please don't hesitate to get in contact with us. We are happy to help with anything and any further questions. Yeah, with this, I would like to say a big thank you to my 2 colleagues also, Ronnie and Jürgen. It was super interesting, I guess, and I'm looking forward to a lot of questions coming after this webinar. Have a great day to everybody from Vienna, to all the regions that participated. And yeah, Jürgen and Ronnie, you can go back now managing your funds successfully as in the past.
Thanks, Carmen.
Thank you, Carmen.
Thank you. Goodbye, everybody.
Bye.
Bye.